Thank you. Welcome everybody, and thanks for spending a few minutes with us today as we talk a little bit about online sellers and their sales tax responsibility. Today's presentation, we're going to talk about three specific questions that we believe all online sellers should consider and review when it comes to determining what your potential tax responsibility is in various states. And so I've kind of broken this up into three specific questions that I hope to answer through today's webinar. The first question is, do I have Nexus? The second question is, are my products and or services taxable? And the third question is, how do I sell my items online and why that matters, and through the method of sales. So once you understand these three aspects of your business operation, and you have a clear picture of that footprint, you'll have a better understanding of how to comply with sales and use tax laws in the US and Canada. And once you know how to comply, then you'll have a clearer picture, at least I hope, of what's next and what's next to come. So the first question and first topic that we want to address today is do I have Nexus? And there's no better way to start than with establishing a definition and helping understand what exactly is Nexus. And Nexus can be defined as a minimum connection. It's that link or tie that allows a jurisdiction to require you to register, to collect, and remit their sales and use tax in their jurisdiction. That's a very clean and simple definition of what Nexus is. Once you've established Nexus, then the state or the jurisdiction can impose their sales tax laws on you as a business. And from that Nexus establishment date, that's when you're required to register, to collect, and to remit the sales tax in the given jurisdiction. Andy Johnson, the founder, as Ryan mentioned, one of the founders of Peisner Johnson, wrote a book titled Start with Nexus. This book was written to CPAs and accountants to help with consulting their clients from a sales and use tax perspective on how to become compliant. And it truly does start with Nexus because it's that pivotal moment when sellers become responsible for collecting and remitting the tax to the state, like I mentioned just a minute ago. So this is literally step one in understanding your sales and use tax responsibility when selling online, to start with Nexus. So let me explain a couple of ways, two specific ways that you can establish Nexus through many states, through every state. And this is something that we deal with on a daily basis and something that we talk on and preach on daily. So the two most common here are physical and economic Nexus. And when I say physical Nexus, I want you to think of where you as a company or individually are located and where your product is located. And when I say economic Nexus, I want you to think of where your customers are located or where you're shipping product to, where you're making deliveries to. So first, let's start with physical Nexus. Physical Nexus can be established through inventory, through employees, through independent contractors, even sales reps. To many people's dismay, making deliveries in your own vehicles also establishes physical Nexus. The second aspect, economic Nexus, as some of you may know, back in 2018, the Supreme Court agreed that Wayfair had established enough of a connection in South Dakota, and so they started establishing this economic Nexus law. Physical Nexus did not go away because economic Nexus became another prong or another way that the states can impose Nexus or impose their laws as a result of establishing Nexus. Physical Nexus is still there and still is valid and something to review. The economic Nexus is simply another way for the state to require sellers to collect tax. It's what they've deemed as a Nexus creating activity. And that threshold, you have a physical threshold of your independent contractors, your inventory, that threshold is physical. Then you have another threshold of economic, and the economic threshold is a number of transactions given in a 12-month period. Depending on the state, it could be a rolling 12 months or a calendar 12 months, but a number of transactions and a total sales amount. And that total sales volume in the South Dakota case was 100,000 in total sales. 200 transactions is the total number of transactions. So in the South Dakota case, it didn't matter if you made 200 transactions of $1 or $10 each. It didn't matter it didn't matter the amount. It just mattered the volume of transactions. So once you exceeded 200 transactions, you've established economic nexus in the state of South Dakota. Almost every state today has established economic nexus. So it's very easy, it's more common, I should say, for people to establish economic nexus, just given the thresholds that have been established with the economic nexus legislation. We've established what nexus is and how to establish nexus. So our next question that we're going to discuss is taxability. And you consider taxability because it is very important, because it'll have a big impact if you sell items that are not taxable. So Nexus is what puts you on the hook to be required to be registered, collect the tax if there is tax to be collected, and to remit it. And I say if there's tax to be collected because you could be selling product that is not taxable. Generally, in general terms, tangible personal property, or TPP, is subject to tax. In general terms, services are not subject to tax. But of course, in sales tax, it depends, as most things do, what those goods are and what those services are. Services could be taxable if they're enumerated in the law. TPP could be non-taxable, given the type of TPP that you sell. It could also be taxed at a reduced rate, potentially. So determining what your taxability is, or finding out and confirming, are my goods taxable or not, is very critical, because what we've seen with a lot of sellers is if they have no tax liability or tax responsibility because what they sell is exempt or not subject to tax, or perhaps all they sell to are wholesalers or other retailers for resale, then that tax liability is reduced down to nothing. And so, yes, I have Nexus in the given state, but my tax liability is zero. So that's going to have a big impact on what you do next, as far as taxability goes. So very important. Another item that Andy mentions in his book, Start with Nexus, is he says specifically to the CPAs and accountants, mind you, which I think is also applicable to business owners, to people who are trying to run a business, is stop worrying so much about Nexus and think about materiality. And it's very, very true, very applicable, right? I mean, yes, I have Nexus, but if the tax liability or my tax responsibility in a given state is so minimal, as a business owner, you may take the risk of, if I'm audited down the road, I'd rather pay, $10 or even $1,000, a certain amount. You're going to have a threshold that you'll pay under audit, rather than being proactive, getting registered and collecting the tax from the customer. So I thought that's very applicable. Understanding the taxability of your goods and services should help you see the bigger picture, and will also help you understand what's material to you specifically. Question number 3 is the method of sales, or how my online sales are made. And this is crucial because, just 2 years ago, we started learning about this new term of marketplace facilitator laws. They're just starting to roll out, even just in the last month or two. Additional states have come on board with these marketplace facilitator laws. So what is a marketplace facilitator? A marketplace facilitator is merely a company that allows users to sell goods on their website. So it's an online solution that brings both the seller and a buyer together for e-commerce purposes. And common Amazon or common marketplace facilitators are Amazon, eBay, Walmart, Etsy, Best Buy. I mean, there's many out there, and more continue to grow and develop. So those are common marketplace facilitators. The marketplace laws, as I mentioned, they're new in 2018, and what's funny about these is it's both helpful and confusing for online sellers. Almost every state they have established marketplace facilitator legislation, which is helpful because it shifts that liability, the tax responsibility of collecting and remitting the tax, from the seller to the marketplace facilitator. So the seller is no longer able to collect the tax directly from the customer. The facilitator then manages that. So if you're on Amazon, for example, or any of these other facilitators, Amazon literally disables your tax configuration so that you can't adjust it or fix it. They manage it all, they collect the tax, they report it. Where it's confusing is on the reporting aspect. Well, do I still have to report those sales to the given state? Do I still have to report the tax that was collected? How does that get reconciled under audit? You know, there's so many questions that come, but so that's where it adds complexity and confusion. And then the other complexity is, what if I make sales on another platform or another like my own website, or maybe I have a physical location like a store. So the method of sales, you have your marketplace sales and then you have all your other sales. So those method of sales really adds complexity when it comes to filing and remitting sales tax returns on a monthly or quarterly basis for marketplace sellers or online sellers. So just something to be aware of when it comes to your method of sales. Just if you were to sell all your goods through a marketplace facilitator, and the marketplace facilitator law is enacted in those states where you're making sales, then your tax responsibility, again, goes down to zero. And if your tax responsibility is zero, then that impacts what you do next. You may consider not registering, as you may not have a tax liability. You may not have a tax responsibility. You may decide to register and report those sales because you've established Nexus. So you still may have a tax responsibility in a given state. And so from a understanding perspective, from a review perspective, you definitely want to take a look at, okay, here's where I definitely have established Nexus, but based on the taxability and the method of which I make my sales, I don't have a tax responsibility. And that'll have a big impact. And so at Peisner Johnson, we've kind of taken this what's next question, kind of a funny play on words, if you will, where next, we've taken and defined it as Nexus, and the T in next as taxability. Prior to economic nexus, just a year or two ago, these are the only two aspects that we would review from a general perspective. Where do you have nexus, and what's your tax liability? What's taxable based on what you're selling and how you're doing business in the various states? Until you've established nexus, you don't want to look at taxability. So it truly does start with nexus. Let's start with nexus. Let's determine where nexus has been established. And then we'll talk taxability. Let's talk about materiality. What are your sales volumes like? What's going on in the state? And how can we reduce that tax liability in the state to kind of help make a smart, educated business decision? At Peisner Johnson, if you visited our website, if you haven't, please go to our website. But we talk heavily about our What's Next call. And we even have a section of our website. What's up with what's next type of a deal. And this is it specifically. This is just true insight as to how we operate and what we do on a daily basis with clients. Is we schedule these free consultation calls where we merely go through these items specifically. On the conference call, we'll talk with you about your Nexus footprint. Have you reviewed where you have Nexus from a physical and economic Nexus perspective? If you've met those, then we'll move on to product mix, what you're selling, and the taxability of that product. In general, here's how we see your product being taxed, and here's how we can mitigate some of that tax liability given how you're making those sales, the method by which those sales are made. So we'll discuss the potential tax responsibilities that you may have, and then we'll talk about potential registrations. And if you're already registered, filing or remitting sales tax returns, and we'll talk about potentially deregistering and reducing your compliance footprint. That will help in the long term when it comes to, the number of states that you're trying to be compliant in. Um, and then once you get registered, obviously you have the tax return filing I've mentioned, how to file returns, how to remit the tax to the proper jurisdictions, when the due dates are, when to make payments, so on and so forth. It's surprising to some clients when we jump on these what's next calls, that at the end of the call, they're left with, there's nothing to do. And it's not surprising to us because it is common, but it's surprising to a number of clients and prospective clients that there's really nothing that they need to worry about. Either A, they have an established Nexus, or B, they have established Nexus, but the sales volumes and the transaction amounts, they're just not material enough for them to want to take action at this point. And that's totally fine. And that's what we walk through and talk about specific to your situation. Here's how long I've been doing business. Here's when Nexus was established. Here's where my employees are, so on and so forth. And so our goal and our desire is to provide you peace of mind. And so that's truly where we feel, by reviewing these items with you specifically on a What's Next call, provides a whole lot of peace of mind and comfort, to where you're no longer having to stress and worry about, what is my tax liability? Should I be charging tax here? What should I do? And until you actually speak with a tax consultant, an expert in the field, whether that be us or maybe one of the partners that we work with, um, you know, clients struggle with that with finding that peace of mind. So hopefully by going through these things, on our webinar today and joining a What's Next call, you'll be able to get that true peace of mind. And that's really what my hope is today through this webinar, and also my hope and desire in joining a What's Next call with either myself directly or one of the many experts on our team and our staff. So I would encourage you, if you would like to jump on a What's Next call and that sounds good to you, to just follow the link or go to our website and schedule a What's Next call, so that we can jump on a quick walkthrough of your business operations and help you with that. The last thing I wanted to walk through with you are just some costly mistakes that online sellers have made that can easily be avoided by just taking a few simple steps. And these are generally exposed when walking through your situation and reviewing it from when Nexus was established, whether on a What's Next call or just reviewing it internally yourself. You'll find that a lot of these little things come up. So the first one, ignoring the situation. Many online sellers, we even talked with one today, who think that if I just ignore the letter from the state, it'll go away. They'll just go away. But by ignoring the situation, if you're ignoring a letter from the state, or potentially you're ignoring collecting tax, even though Nexus may have been established, by ignoring it, you're just making the problem worse. You're compounding that situation. So do not ignore the situation. Sales tax is a trust tax. It's designed to be a tax that you collect and remit to the state. The state imposes it on the business, otherwise they would never get that tax. And so if by the state imposing it upon you, if you don't collect it, that's what we refer to as the biggest tragedy in sales tax. It's tax that you failed to collect at the time of transaction, but under audit, you're having to pay that tax plus penalty plus interest out of your own pocket, when you simply could have collected it from the customer and paid it to the state. And then you would be good. So don't ignore the situation, first and foremost. Second, failing to collect the tax at the time of sale is the biggest tragedy in sales tax, like I mentioned. Registering without a VDA in place, there's solutions and ways out there that you can limit your exposure, your tax liability. And a voluntary disclosure agreement, a VDA, is one of the most common, as well as an amnesty program that the state may have rolled out. But there are ways to limit your tax liability if you've been doing business in the state for a while and you have a material amount of tax or a material amount of tax responsibility. So if you were to register effective today and disregard your prior tax liability or responsibility, it could come back to bite you in the future. Surprisingly enough, as we continue to consult with clients, this is a common thing. People just think, I'm just going to register and turn it on and get going. get registered going forward. And to be honest, on a what's next call and in our review process with our current clients, this may be a valid solution, but you have to understand the pros and cons that come with it. And if you have some materiality for historic purposes, then you probably don't want to go that route. So it's not a fix-all, and it's not a solid solution for everybody. Staying registered where you're not required. Obviously, there's cost of compliance. There's cost to be registered, license fees, return filing fees, so on and so forth. So where we can help mitigate that and reduce your filing footprint by deregistering because you no longer have Nexus, definitely that's a costly mistake. And then remitting tax to the wrong jurisdiction. Another costly mistake that just adds more headache and frustration for yourself and for your team when doing it this way. And so you want to make certain that you have a solid return filing process so that you can ensure that the tax collected is actually getting remitted to the proper jurisdiction. The last thing you want is for a state to come in and audit you and not who hasn't received that tax. You collected it, but you gave it to somebody else who it doesn't go to. So now you have to deal with that and deal with the penalties, deal with the fees, deal with the auditors knocking on your door to try and get that. In conclusion, I just want to make certain that you understand the 3 vital aspects that we feel at Peisner Johnson that you ought to review internally with a tax consultant, whatever your comfort level is. Question number 1 was, do I have Nexus? And we talked about economic and physical. Question number 2, review your taxability. Are my products or services taxable in the given states where I have Nexus? Don't worry about where you don't have Nexus. Wait until Nexus has been established. And then question number 3, why does it matter how I make my sales online? We talked about marketplace and non-marketplace sales. That's it in a nutshell. I hope that is helpful to you, and I hope that points you in the right direction of where to start and how to find that peace of mind. So in conclusion, I'm going to wrap you over to Ryan. Hopefully that helps, Ryan. What do you think?